Hi, my name is Ian Rasmussen, and welcome to our new series, SF Conversations. I'm joined by Harry Kohl and Mike Girard, both from Fitch's ABS team. Today we're going to have a brief conversation about consumer ABS and the trends and developments we're seeing in our sector. So let's get started. Harry, it's been a very active year in the ABS market, but the volume doesn't tell the whole story. Could you talk about the developments we're seeing in ABS, the important developments and trends?
It has been an extremely busy year in 2024. For example, auto ABS is up almost 25% over 2023. There's been a number of new entrants to the market. For example, BNPL issuer Affirm is rated up to AAA by Fitch. There's also been the US CRT transactions, which Fitch has developed methodology for, and has the ability to rate up to AAA. And there's also activity in the private credit markets, for example, from private equity funds who are buying and placing consumer credit.
And we're also seeing developments in performance, and I think in your sector, the unsecured consumer sector, that's been pronounced now for a couple of years. Could you talk about kind of trends there and where we're kind of seeing things going from here on out?
Yeah, especially coming out of the pandemic, when the end of the COVID era relief funds and the beginning of inflation in 2021, we really saw the beginning of deterioration in the unsecured consumer space in 21 into 2022. It started to flow into other sectors, for example, subprime auto about a year later, and then into 2022 and 2023 in other sectors in the consumer ABS space. There's been a lot of tightening, particularly in 2023 into 2024. So we're expecting vintages in 2024 to be particularly stronger compared to 2022 and 2023. Some of the weakness has been due to who has been issuing public ABS deals, but looking at Fitch's DV01 data, we're able to look at managed performance agnostic to who has been issuing ABS, and that's shown similar trends from 21 to current.
Great, thanks, Harry. And Mike, we're in an interesting environment where we still have higher rates and inflation is still higher, but we're now starting to see the job market cool. In ABS, unemployment's always been a significant driver for higher delinquencies and defaults. Could you talk about the job market and what we're seeing and what we expect going forward?
Sure, thanks, Ian. So far this year, we've seen some positive surprises in terms of economic growth, partly supported by the health of the consumer, but we are seeing more borrowers impacted as the labor market continues to cool, driven by higher unemployment, lower job vacancies, and slowing wage growth. Despite though this loosening that's been happening, the market overall remains pretty tight and strong, and more what we would consider to be a balanced market. You mentioned unemployment. That is one of the key drivers we'll look at for loan quality or loan performance, sorry. Typically, if someone loses a job, it has a direct impact on their ability to make payments. The unemployment rate, for instance, has gone up by close to about 100 basis points, and we're currently expecting that to edge up slightly to about the 4.5% range. Though if you look at this on a historical context, it's still pretty strong. On a long-term average, typically that rate's above 5%. The other thing to note here is that when you see unemployment increase by that magnitude, typically it's driven by more so layoffs. But in this case, 40% of the increase over the last year has been really from the increase in the labor force growth. So you've seen newer entrants, including immigration growth, and you've seen more people come back to the labor force. And this is compounded with companies which have reduced their hiring more so than layoffs. So really the permanent job losses only account for about 20% of the growth in unemployment recently. Where we are seeing a bit more stress is really in the younger generation, so those aged 16 to 24 years of age. We've seen the unemployment rate for that segment go up about 2.5% compared to the 1% for the general market. So not only are they struggling with having to find more work, generally they've accumulated less savings over the last several years, and those that are in the market, they've seen less income growth in their jobs. So just less support or cushion to help them if they do hit that financial period of stress. One other metric we look at is wage growth. So we've gone through this period now where there's been significant moderation in wage growth. The labor market's been cooling, and that's really been driving wages to a slower growth rate, similar to what we've seen really in the 2019 period. It's also impacting on a sector level, where you see several sectors actually have wage growth that's lower than what we saw prior to the pandemic. So we've now transitioned from this phase where we had high inflation, as you mentioned. You had wage growth, but of course it was trailing, so that was ultimately impacting real wages. Now it's more of a loosening of the labor market where you have unemployment increasing, inflation's easing, but also wages are going down because there is now this supply-demand dynamic that's happening as there's more of a balanced market, as I mentioned. And ultimately, that's impacting disposable income for these consumers, and this is happening at a time when debt's higher and delinquencies on loans are increasing.
Got it. So it sounds like, similar to what we've been seeing over the last couple of years, the pockets of weakness, that will likely continue as we go into 2025. And Harry, we talked about pockets of weakness. We certainly have seen how kind of near prime and subprime borrowers have been impacted by higher inflation. There's a number of ways that we think about subprime borrowers and maintaining repayment. Operations servicing is very critical. Could you talk about developments there and things that we're watching for?
Yeah, the servicing operations is always incredibly important for loan performance, and that's especially important for near and subprime borrowers. They need more of that hands-on servicing when they go delinquent to bring them current and make sure they make payments. One example, recent example of this is Conn's, a regional retailer who issues public ABS. They have recently filed for bankruptcy protection and are conducting an orderly wind down of the company. Fitch is monitoring this extremely closely due to the need to maintain robust servicing operations to ensure the obligors make payments and the payment flows to the ABS trusts.
Yeah, that will continue to be important for us to do operational kind of risk reviews on a go-forward basis. And Mike, on the subprime auto side, I know that that's been another area of kind of weak performance. Could you talk about where we are and what we expect in the near future?
Sure. So performance for auto ABS has deteriorated compared to the stronger levels that we saw during the pandemic across prime and subprime. But as you mentioned, it's more pronounced on the subprime side, mainly due to the fact that when interest rates and inflation increases, typically you'll see a larger impact on these weaker borrowers in general. Not only that, but they're also dealing with higher vehicle prices and ultimately higher monthly payments at a time when there is that loosening in the job market, so higher unemployment and slowing wage growth, so that's having an overall impact. And we're seeing some of this in our Fitch subprime indices. So the 60-plus day delinquencies, not only has it surpassed our pre-pandemic levels, but now it's at historic highs for our index. However, this hasn't yet to translate in terms to significantly higher losses. So not seeing the same level of deterioration there and hasn't hit its prior peaks. And a lot of that has to do with the fact that these borrowers continue to roll through the delinquency buckets, ultimately making a payment at some point in time and preventing them from becoming defaulting on their loans. Though, as I mentioned, we are expecting unemployment to go up and continuation of the cooling of the labor market, so we'd expect to see both delinquencies and losses continue to deteriorate a bit. However, one important thing to mention here, though, is not all of the deterioration that we're seeing in the index is really due to the macro factors. There's also a change in composition that we've seen. So within the subprime space, we've seen this expansion where there's more newer and smaller players in the market over the last several years, which have been originating loans to the deeper subprime market. So typically you would see weaker collateral, and ultimately that leads to higher delinquencies and losses compared to the ones that are more established players in the market. The other thing to mention here is the story for the used vehicle prices, which those have come down from the record peaks we saw in 2021, 2022, ultimately leading to lower recoveries, especially in subprime because the majority of the collateral is used vehicles rather than new, similar to prime. And this ultimately is impacting loss severity. We're seeing more of an impact on the 2021 and 2022 vintages, just given that those vehicle prices were at the peak levels at that time. Though even with the decrease that we've seen since that point, used vehicle prices are still about 20 to 25% stronger than where they were in 2019. And we've seen a bit more stability in terms of the wholesale prices over the last several weeks, which ultimately is supportive of recoveries for ABS.
Great. Thank you, Mike. And thank you, Harry, for your comments. This has been a very good catch-up. Thanks for joining us today. If you have any questions or would like to continue the discussion, please send us a note at the address on your screen. Thanks for watching.